Okay. Welcome, everyone.
Sorry, 2 seconds. Sorry.
Yeah.
Jason, your lighting is off, eh?
Okay, we're good to go.
That's his look.
Welcome, everyone. I'd like to bring the meeting to order. The time is 2:04 p.m. on April 7th. We have 3 items to discuss today. The annual investment board report for the Finance and Corporate Services Committee, which we need to approve and pass the recommended motion. Potential benchmark revisions and an update on the investment activities since our meeting last November. Does anyone have anything to add or bring for the board before we begin? I'll take that as a no. Okay, Thierry, I want to turn it over to you to go through the investment report, and we'll go through the items and one by one see if we need to make any modifications. Thierry?
Okay, thank you, Jeff. Thanks, everyone. And so the 2020 report is basically the motion reads that the report to the investment board dated April 7, 2021 concerning the 2020 investment management annual report be received for information. So I would go, the first section is basically recital in terms of our powers, or the powers of the board under the Act and also under the City of Barrie bylaw, which approved the board. So I would probably skip over that unless anybody wants to go through those.
I think we all know it pretty well. So
okay, all right, perfect. So
I think we're good.
All right, if that's the case, we'll go under the analysis heading. So starting with paragraph number 8, so which is just kind of an overall commentary of activities or things that have impacted the market in 2020, namely, or the main one being the pandemic, and with the ramification in on the oil market and life as kind of how we know it. So I'll paragraph number 8, is there any comments?
No, I think it's just good you mentioned the volatility in all the different markets that was occurring, because that was quite disruptive. So I have nothing else.
Okay, so we'll go to paragraph number 9. Number 9, again, it's just kind of showing the impact on the equity markets of the pandemic and the awesome V-shaped recovery, if I can call it awesome, though it was pretty scary when it happened. So this is just kind of putting into perspective first the resilience of the equity market, but as well as what caused it to be so, which namely the action of central banks around the globe. So any comment?
So Thierry, I just reiterate, I guess the point of the chart and the analysis is just to highlight to council, yes, it went down, but it's the education part that it has improved to go back up, correct? So we don't own any equities at this point. I think that's really, this is meant to be an education paragraph, I think.
Absolutely, that was the point. So first and foremost, show that, okay, well, for any reservation in terms of, like, well, should we or should we not be looking at equities? So this is if we take a step back and say, okay, well, we're standing January 2020 and we're looking at the market, and then we all worry about, okay, well, should we really be looking at equities? It is a potential that in any given year that you may actually lose some money. Then your worst case scenario is back then would have been something not even close to what happened in a few months later, right? So again, in January 2020, you're sitting down, you're looking at the market, and then you're like, yes, we want to look at equities, but equities are risky. So if it's risky, and then you wanted to put your risk into frame it or think about kind of a worst case scenario, I think that's kind of what played out. So now, if that's the worst case scenario, this gives you, at least with hindsight, we can see what would happen. Like, yes, you had a dip in March, but then you had the recovery. Again, this is
Shelley, I'd say to be a bit careful about that, because there are, in the S&P, for example, there are periods where it's taken 10 years for you to get your money back. So I wouldn't want to make that, make it too big a point of it, as like in that, using that as a time frame.
That's correct, but I think the other thing that we've learned through this, it's so first looking at historical, so you can always see those cycles, right? So whereby you say, okay, well, at any given point in time, the impetus for or the reason why you look at equities is a long-term type of asset, right? So if it's a long-term type of asset, most of the time the risk is really in the downturn, like when things go, if you have a correction, and then this is kind of what most people would look at as kind of risk, looking at equities. So historically, all the way back to now, the one thing that we've seen since 2008 is again saying that, okay, well, central banks or governments have also learned about this economic cycle, and then we've seen more and more action taken by central banks to kind of mitigate some of those risks, right? So back Great Depression, then they kind of let things play out, and then 2008 was a different story. There's okay, well, we have tools and mechanisms to kind of shorten those I guess the recession period, right? So which is kind of what we're seeing play out right now.
I think it's important that, we frame each year like this so that, the people that would be reading this report understand exactly what the investment department has been dealing with in terms of the different forces that are at work in the market. And to your point, Gord, I don't think you want to go too far back and look at stuff. I think you want to frame it in the current situation, because next year might be unprecedented on the upside. So you just don't know. But I think it's very important to lay all this out before you start discussing the results of the portfolio. In every case, it should be done. All right.
Okay.
We'll move along.
Yes. So number 10. Any comment? So I'll move to paragraph 11. So this talks about again what the impact of central banks in Canada and the US cutting rates in order to improve liquidity and bring us into the low interest rate environment that we are right now, again, as a response to what happened caused by the pandemic.
Yeah. And then later in your report, you talk about the impact that's had on some of the returns, because you're trying to roll bills over, and of course the interest rates are very low.
Absolutely.
Again, setting the parameters of what the year was like.
For 12, I would just add a little something that links it back to the points you make in 12, in 11, sorry, like sort of cause and effect, and that the lower rates and government intervention led to the results you talk about in number 12.
Okay. So number 13. 13 was basically, again, just kind of saying, well, yes, equity did rebound, but the engine of the rebound also in terms of the equity specific is basically was tech driven. And then that came from also, working from home, a lot of spending in technology.
And I hate to circle back, but Gord, what do you suggest we put in 12? Just so Theory's got.
I would just like an introductory sentence saying something like these actions by the Federal Reserve, Bank of Canada, and government stimulus programs led to a sharp rebound that resulted in the following results.
Okay,
Jason, you got that?
okay, good, good. Hey, Gord, I just noticed that your name is Jeff instead of Gord Winters.
Oh, that's interesting.
I'm complimented. Thank you.
What a great name, right?
It's all these GWs that causes confusion.
Sorry, I will
Yeah,
change
you're right.
that right now.
Okay. Any other comments on the markets commentary that we just went through?
Just on 13, I think it sort of continues on from our last meeting. We talked about how different sectors were recovering differently and sort of highlights it there. And I thought this comment about technology stocks as long duration assets was interesting. And I hadn't thought of that, went away and did a little more research. And so that was an interesting comment. But I guess going forward, you're going to see stuff, maybe rebalance or sectors again, catch up or, technology maybe underperforming as things get back to normal. So
Right.
Yes.
Rotation in the markets.
Okay, so then we go into that was the background of 2020. Then we go to investment performance. So item number 14, any comment?
Gary, I just realized I should have looked at, I didn't, when I first glanced over it, I probably should have caught this. I noticed in the 2020 budget, we called out a return on investment projection of 2.6%.
Mhm.
I don't believe anywhere in here you recognize that. We should probably reference that. Total
Okay.
investment return was 2.3, which is 0.3% lower than our 2020 budget amount of 2.6, target of 2.6
Okay.
for transparency.
Yep. Yeah, it's always best to put that up
It's-
front rather than someone find it and
Yeah.
make the point to you about that. Yeah, I agree. Had
Yeah,
that happen.
yes.
Mayor would be the one that would call us out on that
Okay.
appropriately.
Okay. Okay. So but Craig, it is would it be because sometimes the issue can we okay, all right. I think we
I'll ask you the question, Thierry. If you look on, you don't need to do it now, but if you look on page 176 of the 2020 budget binder,
Mhm.
return on investments for 2020 was 2.6 was the projected number. So
Mhm.
that's the number
Okay.
we can explain.
Craig, can you just talk a little bit about how you project that number and if you've done so for 2021 already?
Yeah, so we took our finger and I looked at
Always tough to
I'll let
do for
Thierry,
sure.
Thierry can speak to it. 'Cause
Now this is with regard to the budget. Now with the reservation that I wanted to bring is just because the way we budget and then we compute compared to computing total return is not really the same basis. So if you so that's why sometimes we just kind of a little bit hesitant to use the two because just looking at the so the just for context, so the budget is on cash basis. It's basically a cash budget. So if we computing the return based on that, so it's usually basically what they've earned income over the year, divided by some type of average balance. So meanwhile, when we're reporting, this is on the total return basis. So it's again, it can be used, but it's.
So Terry, you have to explain that because like if we're not like if we're putting that number in there, then we need to kind of revisit it. But at the end of the day, we're accountable to what we said it would be. So everything can be explained, right? So I think that's
okay.
We can add a little in as short amount of words as possible and clear as possible. I guess just kind of explain that if cash flows were lower. I think it's actually explained in the write up here. But,
Yeah, it is. Yeah.
Yes. No,
it's not a bad thing, is what I'm saying, Thierry.
Yeah. So the only I'm gonna say I think we added it like in the first draft. It was just because we just wanted to be as we evolve. We just want to make sure that it is kind of apple to apple. But we can definitely reference that. I think there's no issue with that. Okay, so number. So any other comment under number 14?
Oh, I think we're good.
Okay, number 15.
Just going back, so you complete off your thoughts on saying, you know, how you compared to the benchmark. You might add in, compared to fiscal 2019, total return was lower by 50 basis points due to low interest rates, and the portfolio moved to more liquid securities, and say this is also responsible for the underperformance of the portfolio versus the budget. And then you
Exactly.
kind of covered yourself off so that it's explained in case someone says, well, you know, tell us why, and read 15 basically is what.
Yes. Okay, so that's why here we did reference the previous year, because that again, it's the same
Yeah.
basis that we're comparing. So it's year-over-year decline,
Understood.
but not comparing that to the budget. That was the Craig, you see that
I want to put that into 14
number 15?
Because I think you should explain why you underperformed in some form or another.
Mhm.
Question will come up.
Yeah, I think so.
Yeah. So no, I was just referencing under number 15. This is where we kind of referencing like the lower return compared to the previous year. So then it is easier because you're comparing the pretty much the same basis of calculation year over year. Then, you know, we say compared to the previous year, performance was lower. Now that was, I don't know if that.
Yeah, but just keep in mind that if we're saying something publicly, like in that return on investment, we just got to make sure we speak to that. So,
Okay.
no, like Mark was asking, what about 2021? Well, the same number in 2021, it's 1.5% you have in there. So,
Wow.
might be
Yes. So, and
next year, but right.
exactly. So
I know there's a lot of moving parts in it too. I
Yeah.
understand that point. We just have to,
Okay.
that's the number we're saying, and that's the number we do have to.
Yeah. Well, you got to be realistic, right? Like,
Yeah.
you have the tools you got. Otherwise, you know, you're setting the bar too high, and you know you're not going to be able to reach it if you can't get the interest rates to do it.
And that 2020 number, I mean, that we would have come up with that number in well before, I can't remember the date. Would have been like probably October 2019 or something like. I think that's when we put together that budget. So, right, it's
Yeah.
explainable.
We only knew.
So, and just for full disclosure, we are not, what's the saying? We're not forecast, or we're not giving assurance of future returns, right? So it is just, it's an estimate that we have to put in the budget, and then we, you know, to the best of our abilities, it's not, you know, us guaranteeing some type of return in the future. So, which is kind of, but for the sake of, for the budget, we have to come up with an estimate. So,
Yeah,
Mark, I think that's what
always difficult for sure.
Exactly. I think that's what you were trying to get to, right?
Yeah.
Yeah.
Okay.
Okay, under number 16. So this is basically just converting the data into actual dollar amount.
No comments?
Okay, number 17.
Yeah, I had some questions here, and maybe, I don't know if it's worth clarifying a couple things, but when you say, for example, government agency bonds led the way, returning 6.45, followed by utilities. I mean, that's in your portfolio, and correct me if I'm wrong, but that seems to be more a function that your Canada housing bonds and your utility bonds are the longest duration bonds you owned in a falling rate environment. Right?
That's correct, yes.
Because I would expect, I don't know exactly what happened, but all else being equal, I'd expect in a volatile rate environment where rates are falling, you'd have corporate and provincial and municipal spreads widening, even though interest rates are coming down. So the sovereign bonds would probably outperform. So I don't know if it's worth explaining why government agency bonds led the way or not, but so I guess first I'm just looking for clarification. Is that why they outperformed?
Yes, there is. And then there's also, I mean, I think the other thing that you can overlay under that is the preferred habitat or the expectation theory on the yield curve. So you have those market, as you mentioned, just purely based on those, the spread widening and all that. But then also you sometimes have the effect of people picking certain durations or certain credit quality or sector just to buy, right? So which for various reasons. So this can be also added. So, but yeah, we can definitely beef that up. And
I think you have to be careful not to get too far into the weeds on this. Just
Yeah, I know that's,
so you don't
yeah.
complicate things too much.
Yeah, so I just bring it up for discussion. Do we need to clarify it or expand on it, but be my own interest or just to confirm that that was the case?
I think it's best just to leave it as it is. And in theory, if or Craig, if you get asked why, you can maybe shed some more light on it verbally.
Yeah, actually, if we could just add one phrase, so if you say government agency bonds in the portfolio led the way, because it's not in the market generally, but in your portfolio.
okay.
Sounds good to me.
I mean, you talk about yield price relationship in bonds. I don't think it's worth going into spread dynamics, but
You got the basic principle right there.
and then also on the accompanying chart for 17, contribute or the title sovereign agency, electric integrated, municipal, county. Like, do you control these titles or are these coming off some sort of system?
These are from Bloomberg. This is
Okay.
yeah.
Yeah, because I think more accurately, municipal, county should be regional municipalities. Commercial banks, non-US. I don't know why you wouldn't just say commercial banks. And then
Okay.
regional authority, which should be provincial, unless you're going to include MFABC in that category.
So
If you can change the titles, I would.
okay.
I understand that more, Thierry, because if you can do it, I would too.
All right.
I'll put those in my notes to you in terms of minor changes.
Okay. Okay, so number 18, which is SOSTI looking ahead section. Any comments? Paragraph 18.
For 19, I'm not really crazy about this whole business cycle comment. I would be more inclined, and I'm not sure it's accurate. I'd be more inclined to say something about, low interest rate environments, vaccinations, reopening of the economy, anticipated strong economic growth, pent-up consumer demand, et cetera, et cetera. And then also a caveat about inflation, rather than, I don't think this comment about the business cycle applies at this point.
Would also add to that list uncertainty around unwinding of central bank activity.
Sure. Yeah.
So yes, so you want to get rid of 19 altogether?
No, let me see. I would take out the first two sentences.
Okay.
And say something more like the current environment bodes well for equities. Maybe qualify it with despite valuations, the current environment bodes well for equities, given that whole list of things I sort of rhymed off. I'll send you an email if you like afterwards with the list.
Gord, would you copy all of us on that so we can have a look at
Sure.
it?
Yeah. And I don't know if you need to use all of them, but just 3 of them to make the point that it's still, despite strong markets, it's because of these conditions, it's still a good market or a favorable market for equities.
Yeah, I'd agree with Paul too on mentioning the central bank unwind of the liquidity. To me, that's the biggest risk in the
Yeah.
one of the biggest
Yeah.
risks right now. So.
And so going on,
Okay.
I'm not sure, you can tell me, but for your audience, I'm not sure all this stuff about growth and value is really adding anything, because I don't know, we haven't really discussed using growth versus value as a strategy in the portfolio.
Mhm.
So I don't know if it's really adding anything, and it may add more confusion than anything.
Yeah, probably.
But you know your audience better than I do, so.
Okay. All right. So, and just a little bit. So this, like the top section of this was kind of general market commentary, right? So that's just, but you know, definitely, I mean, it's the less technical, the better, especially you know, trying to make bring the point across. So.
Any other thoughts
Okay.
on this? I'm in favor of keeping it in only because, you know, someone might ask the question, well, why don't you own Spotify? Why don't you own whatever? We're going forward whenever you're going to have investments in equities, not that you're going to be directly invested in the equities, probably using some ETF vehicle, but still, I think it's important that people understand that some of the stocks that have been the big winners in 2020 aren't necessarily being the ones that are being the winners in 2021, at least not to this point. So, but that's my opinion on it. But. Anything else?
I mean,
Do we want to change it or not? I guess is the question.
I would keep it in as long as everyone agrees it's factually correct.
Time will tell.
True.
Yes, and again, this is just first and foremost, it speaks to the rotation, right? So I guess right. So from that point of view, basically, right now, if you look at valuation in terms of the so-called growth sector, it just seems to be it's too expensive. So anybody looking at getting into it right now, I think intuitively would probably consider probably your financial and certain you know, things like that, than you know buying a Tesla, you know, just so I think again these are they're thematic in nature, right? It's not a specific you know investment item, but I think from a theme perspective, it kind of speaks to where the market seems to be headed.
Right. Okay. Yeah. And maybe, yeah, it goes, okay, that's fine. Yeah. Leave it in. I you know.
So I'd just add in the risk of central banks unwinding liquidity as a risk to the market
So,
down the road. Maybe
right,
in 21, you can just add that in.
Okay, so that would be under. So currently we're still under 20, right?
I was talking about 21. You've mentioned some risks there. I would just add.
Oh, okay, all right, 21. Okay, all right. So sorry.
Yeah.
Okay. So that would, you want to change the last sentence, or you want to remove the last sentence? Is that?
You could have that, but then just add on to it. Maybe a key risk would be them starting to unwind, not necessarily raising interest rates, but they just might unwind QE, which could be a problem for the markets.
Sooner than the market was anticipating.
Yes, exactly. Yeah.
I think that's what the market would get upset about.
Yeah. So you've kind of mentioned their intention. So the risk, just
however,
to counterbalance that. Yeah, exactly. Would be
another sentence as well.
Unexpected.
You got that, Jason, or?
Yeah, I got that under 21, right?
Yeah. Just the additional sentence.
Got enough words there to make it work, Jason?
I can play with it a bit, yeah.
Oh, okay, all right. All right.
All right, so I think that We want to go into the appendix, or is it? So I guess the appendix would probably be the same. Paul, to your comment, just if we're changing the names, it would be because that's the it's pretty much the same graph, but just
Yeah.
presented differently.
Gary, in number one in performance, you know, you could call out the target of 2.6,
2.6. Okay.
add it in there.
Yeah, I was just gonna add that myself. Yeah, that's a good one. Yeah. Okay,
And
so if you just to go and look at page 7, so both that chart that you had earlier in the report and this chart have to be the same as was the point that was made. So if you can
Yeah.
change them, right? Yeah.
yeah, absolutely. Yeah.
Okay.
On page 7, can I ask a question about that?
Yes.
About the portfolio? Can you just comment on the weighting of the Electra position? Is that legacy holding or is that?
Yeah. So
bonds?
that is basically it is the note. It's a note that we have that the city have with it was kind of a private placement that the city
Right,
has with her. Yeah. So
That's what I thought. Okay, so I want to make sure you weren't also buying a bunch of Electra bonds in the public markets. To double down on your
Well,
exposure.
Paul, what's wrong with that?
Well, diversification, that's all. I'm sure it's a great company. I'm sure it's a great company.
20 million. Yeah, that was from historical when they merged Berry Hydro with
Right.
Yeah, that's what I figured. Yeah.
Yeah.
It's a good return. So
Yeah, it's a good note. Wow.
Well, let's keep it quiet before someone has the idea of renegotiating. All right, so I think that is the end of that section, unless there's anything to be added.
Are we on page 7 or 8, or where are we?
Well, we were just on page 7 so far.
Okay, all right. So yeah, I'm fine with that, with page 7.
Okay, page 8.
Actually, sorry, one more question. On back to page 7. So that total return 441, that's really just the coupon because it's not being marked to market, correct?
That is correct, yes.
Okay, thanks. Page 8.
I was just going to say on the GICs, maybe it would be helpful to include the interest rate on those.
Okay,
Just beside the name, maybe in brackets or whatever. Just
okay.
not a big deal though.
All right. Any other comments? Okay, page 8. All right. Okay, so Jeff, back to you.
Okay, are we complete here, Terry? Any other comments regarding the report?
maybe,
Are we in a position to vote on? Yes, Craig, sorry.
yeah, I was just gonna ask Tara an administrative question.
Yeah, I was good.
So we've got a few minor tweaks to make. How do we want to take a vote, I guess, but
Yeah,
Sorry,
I can
Chris.
do the same as we did with the other 2 reports kind of thing. Just note that I can't remember exactly how I worded it, but that we made, yeah, like we made the additions and whatnot and approved it
I think I've got a statement here to carry it, if that.
Is that, sorry?
Well, I'm just wondering then, so what'll happen is we're gonna vote and if we vote to approve it, then if it's approved, then we've got to recirculate the changes in the report to everyone, right?
Yeah, and that's kind of what we did last time as well.
Off,
Yeah.
I would say off record, but that'll be done, I guess, electronically, email.
Yeah.
And then that'll then be the copy that goes forward. Okay. As long as you're okay with that, Tara, I'm good.
Yeah, I'm good with that. If I can just pull up what I put last time.
So what I was going to say was I move that the 2020 investment management report be accepted with the noted changes.
That's
I think that's the statement we might have used last time.
Yeah.
Okay. So I'll call the vote. All those in favor, please raise your hands. All those opposed, carried unanimously. All right, thank you. Shall we move on to our next agenda item, which is the benchmark revisions? And you may recall we discussed this at some length last November. And Thierry, you want to outline to us what your ideas are on this topic, please?
Yes. So when we last met in November, I guess mainly we looked at the various benchmark, and the plan also really sought deploying the portfolio with starting with the fixed income component. So in the process of doing this, and then referring back to the plan, then it just kind of dawned on us that using the FTSE as the benchmark universe. Now we have FTSE, but again, we said FTSE or similar, right? So I don't want FTSE coming back and say we're using, anyway. So the universe was kind of the benchmark that we settled on. However, during the implementation phase, then it just kind of came the question as to, is this really an appropriate benchmark? For the simple reason that first and foremost, the FTSE has a duration about what, 7 to 8. But not only that, it does not have some of the constraint that our strategy entails, which is really kind of returning cash year over year. So, and with kind of an horizon of 5 years. So just the universe as a whole was not. We don't think that is an appropriate benchmark. Now, what we're more thinking about, things that after looking at the various benchmarks that are out there, probably some type of ladder bond benchmark would probably be if we stay within the FTSE universe. I mean the FTSE benchmark, probably the 1 to 5 laddered government and the 1 to 5 ladder corporate would probably be similar to what we're doing. Yeah. And that is kind of the
what about just using the FTSE short bond index? So they divided it into 3. They have a short, a mid, and a long.
Yes. Now that still has the main issue is really because we are forced to return cash each year, right? So, because it's a cash flow match, each year we are forcing the portfolio, or we invested in based on different horizons. Each year we want to have X amount of money coming back to the city in order to pay bills. So, if we don't have that, then the ladder is kind of replicates the same, because each bucket you have a certain amount of cash coming in.
So it'd be like a short laddered.
Exactly right. So okay.
Yeah.
Is that benchmark easy to access, Thierry?
Well, there's a FTSE, and there are some other benchmark that they're kind of doing the same thing. I don't think we've there. Of course, there's different pricing depending on which one you use. But I think similar to what we have in there, we would use FTSE or something similar that's basically replicates the Canadian corporate 1 to 5 and the government 1 to 5 ladder.
So I think to summarize what you're saying is we want to align the benchmark with what you're actually doing within the constraints of the reality of your investment portfolio and what it has to do for the city of Barrie.
Exactly. That's, yeah.
I fully support that. I mean, if there's no sense setting the bar up here when you're,
No.
you're jumping there. So, and it's, sometimes maybe you like to go really long, but it doesn't make sense from a management standpoint for the city, unfortunately. So Gary, do you want to come back to us with some ideas in terms of what you're looking at doing, or do you have them right now that you'd like to put them out to the board?
Yes, I mean, the FTSE is definitely there now. In terms of vendors, so you have FTSE that has clearly those, and then you have Solactive, which is another benchmark provider. So we have pricing from FTSE, but Solactive, we don't have pricing yet. So I guess it would come down to pricing. I can certainly contact Solactive as well and just get some pricing, and then run it by Craig, and then to the group, and we'll see.
Could I just poll the board? Does everybody think that some of these, this benchmark is just far too high for what the city is actually trying to do within the parameters of their portfolio? Everybody agree with that?
Yes.
Yes. I mean, if he said, what was the duration was 7 versus,
Yeah.
is it 7 versus what you're trying to do where term is 5? I mean, that's
That's not possible.
if you're looking to, you're just going to get yourself in trouble.
Yes.
Yeah.
Yeah,
And
no, I
that's,
agree.
is when we started basically deploying, then it's like, oh, that's the, first thing, just replicating the universe. And then you start realizing, okay, well, if you, anyway, it's just from a process perspective, it was okay, well, we'll try to replicate the universe with the constraint of it being able to cash flow match, right? Then all of a sudden you see a big discrepancy between potential, the yield between the two versions, right? So yeah, you just get a big drag in performance trying to not only replicate but force it to have a cash flow cash return in the interim. So
And I know the short index is about 2.8 years. What's the laddered one? Do you have the? I'm not familiar with that index.
yes, the ladder one, I think it's
2.8.
Sorry,
It's 2.8 for the
2.8. Okay, all right.
2.81 for
Okay, so they're both the same.
No, they're close. Close. Okay.
So yeah, and the idea would be basically just to use a composite of the two, same as we did with the equity portion.
I see. Yeah. Okay. All right. For our next meeting, you want to come back with an asset mix after you talk with Craig about it and the appropriateness of the benchmark? What you think you should consider? Yeah, Craig?
Yeah, I was just gonna say, like, we probably need to make a decision on this, Terry. Like, we can, if we're gonna bring something forward, we gotta lock it in and lock and
Yeah,
load.
lock it in.
So, what's the timeline? And I guess,
I mean, we once we get the pricing, I guess we can. I don't know if we need to do have another meeting, but we can definitely circulate.
excluding the pricing part of it, though, for now, is it something can we just agree on that this will be the benchmark that we'll go with? And then if there's some obscure, if it's some crazy, if there's an issue from a budgeting standpoint, then we can come, like at the next meeting, we can raise an issue. Otherwise, can we not just make the decision, make the call now to go with that approach pending costs?
Yeah, why don't we put in the FTSE index or equivalent, whatever.
Okay.
And then that's done. If everyone agrees, then that's
Yeah.
done.
Do we need a motion for that, or we just need agreement of the board?
I think,
Need a motion?
I think it's more just agreement because you don't need
Agreement?
council direction or anything for that.
Okay. All right. I guess, yeah, okay. So does anyone have a disagreement with changing benchmark? Sure. Yeah. All right, very well.
done.
Go figure it out. We're done.
Okay.
But I'm relieved that we did that because I was very concerned about using the bond benchmark that we were using. It's not fair.
Yeah.
To you at all. So, okay. All right. And I guess final agenda item here is an update on the investment activities since last November. And once again, I think Thierry, you're in charge of that one as well. So let's back and sort
Yes,
of.
I guess I kind of alluded to that already. So I guess the game plan when we after the meeting was start the implementation process, and we had said that we'll focus on deploying the fixed income portion first, and then before starting adding the equity portion. So which is kind of what we started, right? So it's the benchmark issue came during that implementation phase, right? So as we are trying to model, we just kind of realized that if you're doing it with the benchmark in mind, it was just kind of a little bit too hard to achieve. So, but anyway, we started moving some of the cash back into fixed income. So far, I think from we've already deployed about 40 million back into fixed income, and with a little more to go. And in terms of equities, I think the plan still remains, which is going to be a gradual process, probably just over a year. So incrementally, buying toward the next 10 to 12 months to get to our target. So in the meantime, we still have to basically get market data and all that, which we were able to achieve last month. So now we have live pricing on Bloomberg and all that. So so far that's kind of where we are. So we
all right. I've noted that the equities are going to be late, but have your bond changes to the portfolio been hindered by the market conditions being, with such a low interest rates?
Yeah, so this is why kind of we've been doing it gradually as well, right? So it's tough because when you model, you want to basically model and then just get to at least a starting portfolio. But then you kind of looking at the current environment and then just asking yourself the question, or should we fully go and deploy everything now and then with potential to kind of rebalance as you go. And it's just kind of balancing that, right? So yes, we have what the portfolio structure looks like, but unfortunately it may not, it doesn't make sense to basically deploy all at once. So we've been trying to use a phased approach so that at least we get the benefit of different environment. But it's definitely tough to,
and looking for opportunities if they ever do come along. So yeah.
Yes.
Okay. Anything else there?
Correct, I think.
So I guess, and Thierry and I chat about this every now and then on the equity side, and I know we're talking a year. I know when we met in November, there was sort of a suggestion that we should be really looking at each quarter, trying to kind of start to move towards the target. I guess, are we still going to be, next time we meet, still not moving on the equity piece, or are we going to start moving sooner? That's one question. And then two, I'll sort of make a comment. Yet I don't think this is really going to impact us this year, Thierry, but it is possible with the world of COVID that council I wouldn't be surprised in the coming weeks if they decide to kind of waive late fees again on taxes, which has the impact. What we saw last year was generally residential folks who pay taxes will continue to pay on a monthly basis, but pretty much all the commercial industrial folks decide to wait and didn't pay until they had to when the fees, late fees kicked in. So while nothing's been said yet, I wouldn't be surprised if we're put in that situation where there's some cash flow towards the later end of the year when we'll get some of that money back. Last year, the province had helped municipalities by they deferred when we had to pay the property taxes related to the school boards. So we pay in March and June. And last year, they just moved it all to the end of the year to help alleviate some of the cash flow pressures. But it's one thing we're gonna have to kind of keep an eye on, Terry. But as I say, I don't think it'll overly impact what you're doing on the investment side of it. But so if you
Yes,
want to go to the first question on equity, the second part was a comment. The first,
Yes.
first piece
So
was-
yes, I think the equity, the plan is to again, we want to do it incrementally, right? So, but the plan was basically to start probably in the coming weeks, again, small buys, right? So small buys. And I think last time when we spoke was, there's nothing over 10, 12 months, just incrementally buying, into the market. So not big tickets, but, at least that's the plan. So it is imminent in that sense that we think, again, looking at the current environment, there's really, we kind of noted our expectation in terms of performance and all that, right? So you look at this environment and then if we want to move the needle, definitely I think we may get equities would definitely serve a purpose. But again, considering what the current environment is and what the where we are, I think incrementally just building over time, I think will get us there. So that's why
are we going to agree on a target time frame, and like is it 8.25% a month for a year, or is it what's the plan?
Yes, so I think we are planning to just kind of go on a monthly basis, the 1-2 million per month for the next 10 or 12 months. Anyway, on a monthly basis, just kind of start buying, but within I would say 10-12 months was kind of what we had framed. So I don't know if that's
what does 1 or 2 million represent in terms of percentage of the target?
It's in dollar term is I think we are looking at about 30 mil in dollar terms, or if it'll be what
It's like 0.5%, pretty much.
percent, yeah.
So then, just to be clear, is that 1 or 2 million just on your discretion based on what you think of the market, or are we going to be regimented in terms of proportion every month? Is there a minimum amount that needs to go in every month?
So I would say the driving would be basically if that's the schedule, then it'll be just the discipline, right? So not necessarily trying to time the market or anything like that. Just say, well, this is a time frame over which we're trying to achieve the allocation. But again, also kind of bearing in mind what's happening in the market, right? But from a discipline perspective, I think Gordon kind of alluded to that back at the last meeting, whereby if you don't come up with a schedule, you're never going to do it, right? So we want to be cognizant of that, but at the same time, also, if we see opportunities, yes, and then if we think that timing may be off, again, it's not kind of reserving that right to also make some small calls here and there in terms of what we see in the market. But
Maybe
Okay,
we
so
could say something like 1% a month and give you leeway within that month to buy when you see an opportunity or whatever.
exactly, yes.
Maybe something like that.
But I mean, if your ultimate target is 30, right? Your
Mhm.
ultimate equity weight is 30 million. That you're talking about 15 to 30 months if you're doing 1 to 2 million a month. So am I missing something, or is that sort of you're going to do 2 and then wait for opportunities?
So again, from a time frame perspective, I think a year, 10 to 12 months is kind of the time frame. So now it'd be splitting that over those that term. So if it's ultimately 30, then Probably 3 million would be kind of your over 10 million would be kind of your
I mean,
ticket size.
I'm not even, I mean, given where the markets are, who knows? So I'm not really trying to dictate what your process should be, but before you start, you should define your process so that you just do it rather than, I mean, timing the markets you can do once or twice and you're a hero and miss it another 8. So I think it's just important to define your process as precisely as you can before you start. As I said before.
Just a thought, you might set sort of a base level that you're kind of required to do every month. And then in theory, you have discretion to, if you say, oh, okay, well, I kind of like that investment of that sector or the market, you have discretion to up that. But I'm thinking maybe if you have a floor, at least it keeps you going in there. But it doesn't say you must do, this amount, this amount, this amount. You must do a sort of a base level, and then you can add to that at your discretion. That might
I was just looking at our target for equities is about 20%. So maybe we could say minimum 1% per month.
Yeah, when you do start.
Okay.
Yeah, with discretion to go to 2 or something
Yeah.
like that. So you can. So just to give you some discipline, because it's important. As we all know, like when the market goes down, you got to have the guts to get into it. And when the market's high, you shouldn't ignore it, but at the same time, you should be at least moving forward if you have a program to fulfill. So, okay.
Okay.
Good. Any other items for discussion on this topic? And is there anything else anyone would like to bring before the board? And Craig, is there a time frame for the next meeting for us to get together? Do you have things coming up that you're going to require the services of the board?
I don't have anything jumping out at that I can think of, Thierry. Unless you guys want to talk about debt.
Maybe some of us. So
we got some of that we're going to be doing, right, Thierry?
Yeah.
Okay. Oh, good.
I think our commitment is it 3, Tara? I defer to you, 3 meetings
Quarterly.
quarterly.
Quarterly meetings. Okay.
So this is first quarter, so we should probably plan to set one up for second quarter, and unless Thierry has any other needs for it, we could set up the rest of the year if you want offline in terms of whole.
Yeah, I think we do that offline, but I did want to plant the seed that we've got to probably get on a regular schedule, because we are required to review the portfolio every quarter.
Yeah.
How long after the quarter end do you usually have the portfolio details and everything done? Do you need a month or so, or
Yeah, a month or so.
At least
Jason?
a month.
Mhm.
Yeah, a month is fair, yeah.
Okay, that sounds reasonable.
so maybe we set them a month or 6 weeks after each quarter end or something like that?
What I'd really ask if we can get this edits done, and if you have feedback you want to send in, email it so we can get this report done and circulated and over to Tara early next week would be a priority for us.
I'll make sure I review it this week, if I get it this week. Okay.
All right.
All right. I'm going to adjourn today's meeting, and the time is, we're 3:02. Excellent.
Excellent.
Well done, gentlemen. Okay. Tara, I think you can take us off the live stream and we can chat a little bit.
Of course. Give me 2 seconds.